Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about we're going to explore the Bollinger Band and how we can use them as a swing trading strategy. You will learn how to identify market trends, pinpoint entries and exit points, and avoid common pitfalls. So why not stay with me until the end to fully understand the strategy and how it can enhance your trading approach. Now, what are these Bollinger Bands? These Bollinger Bands are technical indicators and they were created by John Bollinger to help traders analyze price movement and market volatility. This, this indicator consists of three lines: the middle band, which is a 20-period moving average, and two outer bands which are placed at two standard deviation above and below the middle band. These outer bands adjust dynamically based on market condition, expanding when volatility increases and contracting when volatility decreases. Now, the upper and lower band are dynamic support and resistance level. You just have to look at them at dynamic support and resistance level. When price approaches the upper band, it often indicates that market is about to go to the downside because of it is an overbought condition. Now, when price moves towards the lower band, we take that as an oversold condition, expecting price to move to the upside. However, these signals should not be used in isolation, but rather they should be confirmed with other indicators, or you can combine them using price action. Now, one key concept to understand the Bollinger Band squeeze. There's something they call Bollinger Band squeeze, and one of the key concepts to understand this is that it occurs when the band contracts tightly around price. Now, if you look at this area in price, you can see the way price squeezed at this area. This is what we call a contraction. After a contraction is always, we expect an explosive move after a contraction. So let's go to the higher time frame to better get an understanding on how we can implement this in our swing trading strategy. And as you can see in this area, there's a contraction at this area. Now, this often precedes a breakout. After a contraction, we expect a breakout. It's either to the upside or it's either to the downside, where price tends to revert to the middle band after touching one of the outer bands. This is basically what it means. After squeeze, it breaks out either to the upside or to the downside. This is basically what we're talking about. Now, it's always important to remember that the Bollinger Band are not predictive but proactive. They are not predictive but they are proactive. They show how far the price have deviated from its average over a specific period. This makes them useful for identifying potential entries and exit points. Now, the swing trading strategy using the Bollinger Band. Let's dive deep into that. Now, to use the Bollinger Band for a swing trading, you first need to identify the market condition. Now, let's not forget that this strategy will work best in a range-bound or moderately trending market. When we see a range-bound market or a moderately trending market, we are expecting our Bollinger Band strategy to work. Now, for entries, there are two main approaches. The first approach is the Bollinger Band bounce, when price touches or dips below the upper or the lower Bollinger Band. As you can see in this area, price dipped below the lower band and broke back inside. You can see in this area, price touched the upper outer part of the Bollinger Band and came back inside. So to confirm this, you can use additional indicators such as your RSI, which I'm about to apply on my screen. Now, by using this, indicator, or you can also make use of candlestick patterns that show you reversal signals. Candlestick patterns such as your hammer, your inverse hammer, your morning star, your doji, your pin bar, and so on and so forth. Let's not forget that similarly, when price touches or raise above the upper band, this is an overbought condition, meaning we are expecting a fall in price. And as you can see at this area, price went above the upper band. So after we saw our candlestick pattern, which was a bearish engulfing, we can take a sell trade at that area, or we can refine that to our lower time frame to get a better entry, and we aim for our 1:2 or 1:3 as the case may be. Or you can use it, you can aim for it to swing after observing the market condition. Same with the market coming to your lower band. You can see after it came into our lower band, it broke in, it broke out, and it broke back in. It broke back in, showing us a candlestick pattern, which is our hammer candlestick pattern with a bullish engulfing. If we can look at our RSI, we can see that our RSI also signal that price is in an oversold condition, expecting higher prices. So this is a typical example of how we can combine our Bollinger Band with our RSI indicator. Now let's not forget that we have a second approach. The second approach to how we can use this Bollinger Band is the Bollinger Band squeeze. Now this occurs when the band contracts tightly around price, signaling lower volatility. And as you can see at this area, there was a squeeze. In this area, if you can look at this area, there was a tight squeeze in this area, which signals that price is trading on what we call a low volatility. So a breakout usually occurs after a squeeze. So after a squeeze, you are expecting a breakout. If price break out from the upper band, as you can see in this example, it broke out through the upper band area, you are looking for buy signals. While if it breaks out to the lower side, we are expecting sell signals. Now let's not forget that risk management is also crucial in this strategy. You would always have to place your stop loss just above or below your previous swing zones. For example, let's say we take a buy trade at this area. When we take a buy trade at this area, you are going to put your stop loss just below the swing low or the outer part of the lower band. Now in terms of a sell trade, you would want to put your stop loss above this previous swing high, or you aim for your outer upper band. This is where you would want to put your stop loss at. For bounce trade, you have to aim for the middle band as your take profit level, while for a breakout trade, you consider using trailing stop loss to capture extended move while locking in gains. Now there are some common mistakes that we need to avoid while trading using the Bollinger Band. Now one of the common mistakes is the misinterpretation of signals from the Bollinger Band. Many traders assume that a touch of the upper band automatically signals a sell trade, or when it touches the lower band, it signals a buy trade. However, this band reflects volatility and not guaranteed reversal. It is essential to always confirm your signals with other indicators such as your RSI, which means you confirm overbought, oversold regions, or you can make use of your MACD to avoid entering trades prematurely. Another mistake is ignoring the market condition. Bollinger Band behave differently in trending market and in a range bound market. For example, a strong trend, when you see a strong trend either to the upside or to the downside, when you see a strong trend, price stay near either the lower band or the upper band. That as you can see, this is a strong trend, and you can see the way price is staying closer to the lower band. In this case, when price is touching the lower band, you cannot say you are expecting a reversal because this is a strong trend. Now in a strong buying trend, you can see price is just trading along the upper band. This is typically what it means that you must surely combine this strategy the Bollinger Band strategy with other indicators to further strengthen and giving you more confidence when taking the trade. You always have to understand the broader market context and combine the Bollinger Band with support and resistance level. You can use support and resistance level to always avoid fake break signals or fake false signals. Over reliance on the Bollinger Band alone is another pitfall. While this might be useful, relying solely on them, they can also lead to mixed opportunities or false signals. So you always have to pair the Bollinger Band with other tools such as your candlestick pattern, your volume analysis will also provide a more complete picture of the market dynamics. Let's not forget setting tight stop loss just outside the band is also a common error. Remember, we are talking about the common mistakes that we can make. You do not want to just take a trade at this area and you would want to set a tight stop loss because price can whip you in, whip you out and move in your direction. So to always avoid that, you have to set your stop loss at a comfortable region, previous swing highs, previous swing lows, as the case may be. These are where you can set your stop loss orders. You have to give your trade some breathing room. So always remember to set your stop loss and give it allowance while in the trade. Tight stop loss is very wrong when trading using the Bollinger Band because sometimes we logically expect price to respect these boundaries, but market is always unpredictable. So you would always have to account for market misbehaving when setting your stop loss. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. So if you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.